Good afternoon, and welcome to our investment markets and economic update town hall. I'm Bob Hapanowicz. I think everybody knows me. With me today is our Chief Investment Officer, Andrew Batty, who's joining us from Fort Mill, South Carolina. And today we'd like to touch on the three sections of the meeting. We'd like to touch on the first quarter results in portfolios. We'd like to talk about what's influencing portfolios and results today. And then finally, we'll wrap up with our outlook going forward, what we're looking for as we work in through the second quarter of this year and into the second half of 2024 and beyond. So we'll start with the first quarter 2024 review, and I'm going to ask Andrew to talk about stocks and bonds, predominantly in portfolios. Those are the two largest holdings for clients at Hapanowicz. Andrew, tell us about stocks in the first quarter of 2024.
Yeah, Bob, absolutely. And thanks everybody for joining us today. I am Andrew Batty, the Chief Investment Officer here at Hapanowicz and Associates. The beginning of the first quarter especially was fantastic. We saw a real continuation of what we consider that Goldilocks economy in the end of the fourth quarter of last year, which was low or lowering inflation and solid earnings. And that really led to increases in the equity markets. As we see on this chart here, it was a risk-on rally. We saw a lot of momentum in the communications and information technology sectors. Those bond proxies on the other end, though, utilities and real estate, the areas where you go to seek yield, really kind of struggled versus the rest of the market. And we'll kind of get into that on the next slide. But what we tended to see here was, as investors expected rate cuts this year, that really flooded the market with a lot of optimism. And we see that with things like the communication services up double digits, information technology, energy, industrials, all up over 10%. And that's really the markers of a risk-on market in the first quarter.
And how about bonds? You alluded to bonds earlier a moment ago. How did those impact portfolios in the first quarter?
Yeah, so we did see a lot of good and solid economic data in the first quarter, and that was leading people to expect rate cuts. As the quarter went on, however, we saw some of those indicators and inflation indicators kind of creep back up. And we'll get into how that last mile is really the most difficult later. But what this did was it pushed out the expectations for rate decreases to later in the year. And that impacted bond prices because they became less attractive. So bond yields increased, which means that the bond prices, which work in inverse to the yields, decreased. So the overall total return of bond indices was down for the first quarter. Now, what that does do, however, is increase the yields that you're able to capture as an investor. So as we look out and Hapanowicz looks out, what we see is opportunities in the short to intermediate high quality space. And so that's one of the places we've been focused on, is really just capturing that yield. Because if bond prices are going to stay relatively muted, then what we need to do is effectively sit back, take the risk off the table, and just clip coupons. And that's what we've decided to do here. And that's been a very winning proposition for investors so far this year.
Okay, so when's the last time you actually clipped a coupon, Andrew? That's been a couple of decades, I think, hasn't it?
I have never actually clipped a coupon, but I do know that that's where the term comes from. And so bonds will pay a periodic yield or periodic payment to investors for holding that paper. And that's what we call the coupon. So as the yields went up, and we saw investment grade and even treasuries paying close to 5% on the short term, the short part of the curve there, that's very, very attractive to be able to lock in that with effectively little to no risk in an investor's portfolio.
So I love this phrase. You've coined this, the prettiest house on the block. What does that mean?
It may not be the best house in the entire world, although this one kind of is, but if you're looking down the street, you want to find the best and the prettiest house that's there, even if it does have some flaws. And that's what we have in the United States. Coming out of the COVID period where there was a huge drawdown in the market, the United States actually recovered better than almost every other country in the world, and especially the developed countries out there. We started to see the consumers come back, the industrial production come back, the demand for consumer goods and services come back far faster in the United States than we did elsewhere in the world, and specifically in Europe, where they were trailing the United States significantly compared to their recovery. That continued on in the first quarter of this year. As you see, the United States posted a 11.1% return The global, which is the ACWI, puts it at 8.3. Developed ex-US, which is dominated by Western Europe and Japan, returned only about 6%. So the US effectively doubled the return in the first quarter as the rest of the developed world. The emerging markets are having their own struggles, whether it is macro-based, political-based, or just simply economic-based, which is kind of the case in China right now. Emerging markets really, really struggled. There were pockets of positivity there in emerging markets, but one of the big headwinds the EM countries have faced is the dollar has remained incredibly strong. So a strong dollar is going to weigh on their exports. If the dollar decreases, that should help their export economy. For a lot of the EM countries, they depend on exports for their economic survival. And as the dollar's been a weight on them, that's been a struggle. So what we see right now, and we're going to step back first to equities. Within equities, one of the things we want to make sure that we focus on is evaluating the risk and the opportunities in the marketplace. Obviously, during the first quarter, it was a risk-on rally. We took advantage of that with a lot of our equity positioning. On the other hand, we have seen a brief pullback last week, and so far in the month of April, the S&P, as of last Friday, was down 5.5%. So we're going to get into this later. Should we be concerned about that drawdown? Maybe, maybe not. We'll discuss it. What we do see here are opportunities, and what dominated the headlines for the vast majority of the first quarter were the Mag 7, the so-called 7 largest companies in the S&P 500 that were driving the earnings reports, that were driving the momentum of the entire market. Those stocks really, really led the market into positive territory. What we saw towards the end of the quarter, and this is really important for investors, is a broadening out of performance. We see those other 493 stocks really taking off and really starting to catch up with that Mag 7. And that broadening out of performance is fantastic for investors, because it doesn't mean that you have to effectively load the boat into 5 or 6 names, 7 names to really beat or stay with the market. That presents opportunities for us as we see that broadening out, and we can see that going both across style, across size, and everywhere in the marketplace. So we're looking down cap right now into small and mid cap equities. We're also looking internationally. That's a very, very fertile ground for us right now.
So this has been a big topic for the last year or two. We've had rising interest rates. The Federal Reserve and Jerome Powell have been on TV, it seems like almost daily, and some muted language and not so muted language about what their expectations are. And he's got this committee of participants around the country that are all very opinionated. Put it all together for us, Andrew. What is the Federal Reserve talking about? What do they mean by inflation, and what do they mean by interest rates helping to control the direction of the economy?
The first thing we need to do is kind of establish why we're hearing so much from the Fed, right? And one of the things that's very important here is the Federal Reserve has become, since the early 80s, a very data-driven organization. And what that means is that we now understand and can kind of predict what the Fed is going to do, which gives transparency to their decision-making, which is good for the markets. It doesn't come as a shock when they raise or cut rates. So that presents transparency. It presents a little bit of a smoothing out of the reactions by the market to what the Fed is doing. At least that's the idea. Now, what we saw in mid-December of 2023 was Jerome Powell came out and had some comments that were interpreted as being very dovish. And so the market was expecting 5 to 6 rate cuts at the beginning of this year. As the data came out at the beginning of the year in January, early February, that really coincided with those dovish comments. The rest of the Fed governors have been trying to talk back and walk back Powell's comments from December to tell the market, look, everybody needs to calm down. We may be higher for longer. And that's the real key right now, is that we are expecting a higher rate environment for longer than was expected at the beginning of the year. Now, what that means is that as we've seen data come out, and especially something like the PCE deflator, which is the Fed's preferred measure of inflation, it was decreasing at the beginning of the year. It has gotten sticky recently. And so that's pushed the expectations for rate cuts out farther, both reducing the number and pushing them out farther in the calendar year to when we expect them to occur. So what we're looking at now, instead of the 5 to 6 rate cuts that we saw at the beginning of the year, now the market is pricing in 2 to 3 rate cuts, and those only beginning in mid to late summer, which is a drastic change from the beginning of the year. What that does to investors is kind of changes the calculus for how we look at the markets. And the reason is, especially if we're thinking about small cap growth companies, which a lot of times may be pre-profitability, those companies are going to be measured based on their path to profitability, how long it's going to take for them to grow and to fund that growth to get to profitability. Because we here at Hapanowicz and Associates really believe that earnings and those positive earnings and profits are what is going to really drive the price of those stocks. With interest rates still being elevated and still being potentially higher for longer, that's going to put pressure on some of those pre-profitability companies because it costs them more to fund their own growth. And it pushes out potentially their ability to become profitable, which then impacts the real cost and the expected value of their stocks right now. So that's why we saw a little bit of a weight to the tape on small caps at the beginning of the year. And every time we saw some data that came out that showed or potentially pushed the Fed rate cuts out farther or reduced the number of them.
Pushing out originally, beginning of the year, people were talking about several rate cuts this year, perhaps starting as soon as the spring. And now that looks like it's the first rate cut might not be till the fourth quarter, if at all.
That's right. And the other thing is that the market has really, if you look at the chart here on the screen, the market got very, very accustomed to low interest rates. But if we look historically, we were in a low interest rate environment, and that has not been the trend over history. So, while we may think of it as a very, very high environment right now, and it is compared to recent history, over the longer term, this is not exactly what anyone would consider abnormal for interest rates.
I recall, I'm maybe a little bit older than you. I recall the misery index back around 1980, and Gerald Ford was running his campaign for presidency at the time, and it was the misery index added up to 30, and that was the sum of inflation and unemployment. And that's when inflation was running at double digits, mid-teens, and obviously interest rates were at that level too. So these are that was high, historically very high. But yes, if we had a longer term chart here, we would see that the rate environment we were in a couple of years ago was abnormally low, and that was created by the Fed, quite frankly, right? To stimulate the economy through COVID. All right, so the last mile is hardest. To me, this is like lifting weights. If your goal is to lift 15, do 15 reps, that 14th and 15th rep is the hardest, but that's probably where you achieve the results. What do you mean here, Andrew?
Yeah, that's exactly right. I think one of the biggest missteps this Fed made was at the beginning of COVID, really calling the inflation transitory. And I think everyone became kind of numb to that word over time. And what we've seen now is a very sticky inflation. So if you look at the chart here, we can decompose what's driving inflation into supply-driven contributions and demand-driven contributions. The rest of this is considered ambiguous, but what we saw post-COVID were real supply constraints. And I think everybody remembers not being able to get toilet paper at the grocery store, not being able to buy a new car potentially because there weren't enough chips available to make all the systems work in the cars. There were significant supply constraints and bottlenecks around the world for any sort of good that you were looking for. That really, really ratcheted up the supply-driven inflation. Demand-driven inflation came from all of the liquidity that was injected into the marketplace. Consumers largely still were able to spend money, but frankly, there wasn't a lot to spend on, so there became a scarcity element to that. The prices went up as firms took advantage of that environment, and we saw that inflation really being driven by both supply and demand. What we've seen recently, though, those supply constraints, those bottlenecks globally have really been mitigated a lot for the last 1 year, let's say, and they're getting better day by day. Now, yes, there are still issues. There are clearly concerns in the Red Sea. There are concerns elsewhere in the world with macro issues, wars, etc. But that hasn't really impacted the supply chains for most goods that we are dealing with here in the United States. Now, there could be some nearshoring, some onshoring of operations, but also where we are getting most of our goods hasn't been impacted by the wars or the Houthi rebels in the Red Sea. So we're seeing that supply inflation come down. Demand inflation is still there because the consumer is still relatively strong in the US and still spending money. What we're looking for right now and what the Fed is looking for is for both of those to come down just a little bit. And they've ticked higher over the last month. But as those really begin to drop, that's when you'll see the rate cuts. And so that's the really difficult part. It was easy to make giant gains when you were starting from a huge number to begin with. But now that we get closer to the Fed's 2% target, it's really difficult to knock those last couple of tenths of a percent off of the PCE.
Makes sense. Tell me about wage inflation. This has been a component driving inflation, the broader inflation measurements. Tell me about wage inflation. Where's that headed today?
Yeah, I think one of the big concerns during COVID, and especially coming out of COVID, was there was going to be a wage price spiral, which in fact, what happens is prices for goods go up to keep up with that. Wages for consumers go up. It becomes kind of a tit for tat situation. Everything goes up. That is a horrible situation for the economy and one that luckily we avoided. And what we've seen recently is that wage growth has moderated. And that is a good thing for inflation because as we see, typically wages will either follow or sometimes lead to more inflation. One of the biggest ways this occurred was the job market got incredibly tight. There were more jobs than there were potential employees. And so companies had to pay up for the employees that they wanted. And that's why you saw a lot of people changing jobs. And as you look here, at least on the left side, the gap between the pay increases for the person staying in a job and switching a job was very high. It was over 6%, pushing 7% for job changers, where it was just over 5% for job stayers. We have seen that gap narrow over time. And in March, it got even more narrow. So as that narrows, it's really showing us two things. One, it's unlikely that's going to lead to a wage price spiral. But two, it also shows that the job market is loosening up, meaning that there are fewer jobs for the same number of potential employees, which makes it advantageous for companies because they don't have to pay up for the talent that they want to get, which to all of us, if you're looking for a job, that sounds bad. But for the overall economy, that's a positive as we look for that at least function of inflation declining.
Okay, so let's talk about our outlook moving forward here. And we're on the final third, and then we'll handle some questions after this next portion of the presentation. So our outlook moving forward here for 2024 and beyond, Andrew, let's talk about stocks first of all. And this is just, your chart here is the Russell 3000, which is just US stocks. It doesn't talk about international stocks, but by and large, it's a pretty good proxy for most companies trading in the United States.
That's correct. So the Russell 3000 is considered an all-cap index. It covers the 3,000 largest companies in the United States. And one thing to note here, we talked about how the U.S. was the prettiest house on the block. We're looking here at the U.S. and we're going to talk about subsequent returns with this chart. One of the things that has really been good about our investment committee here at Hapanowicz and Associates was we saw this dynamic. And so we were overweight the U.S. in our portfolios, which was a good position to be in for us. But as we look forward, one of the things we like to do is look at history, because while it may not be exactly the same, it probably rhymes a little bit. And when we look at the trailing returns of the Russell 3000, and one of the big indicators for what leads to that return is the current PE ratio of the index. Right now, the Russell 3000 is trading at about 18.6 PE, which is 18.6 times earnings. That is relatively high to history. But as you can see across that chart, it's not the highest we've been, not by far. But what this does is this equates to about a 6.3% annualized return over the next 5 years. Now, is that guaranteed? Absolutely not. But you'll see that that chart has a very distinctive line, or a diagonal line going across it from top left to bottom right. And that means that what we're looking at is statistically significant. And so it is an indicator of what should be expected in a relatively normal environment. So we still think that equity markets have room to run. That being said, we are looking for opportunities. And when you do get to a position where you have elevated valuations like we do now, there are potential pullbacks. there's potential froth in the market. And when those occur, that's where we like to, as an investment committee, nibble around the edges to pick up some opportunistic equities or opportunistic trades that may just frankly be on sale. And that's what we're going to see periodically. Now, that's not something that we do on a large scale basis. We do not want to be opportunistic or tactical with portfolios in general, but on the margins, we absolutely look for opportunities that we see are kind of clear opportunities to take advantage of a market dislocation. And there are some of those right now. But what we're seeing is a very attractive market, a broadening out of equity performance beyond those Mag 7s. We are seeing opportunities where there are stocks and companies that are trading at very attractive valuations, meaning that they are cheap relative to their peers, and they're still really good companies. They have good management teams, good fundamentals. They have a good presence in the market, pricing power potentially. Those are the opportunities that we want fund managers and that we want our strategies to take advantage of because we think those are where the opportunities lie.
What's a drawdown? First of all, please define a drawdown and let's talk about how those affect portfolios and what we should be looking for, please.
Yeah, absolutely. So you can call it any number of things: a drawdown, a pullback, a correction. Typically, people are going to consider a correction or a drawdown a bit more than 10%, which, as I said, so far this month through last Friday, the S&P was down 5.5%, which I think anyone would say is a pullback, but we would not consider that a correction. The real key here, though, on this chart is to look at all of the trailing years, and this is over 20 years of data. And the orange columns are the average drawdown, or excuse me, is the max drawdown within that single year. So you'll see some enormous numbers there. The blue lines are the annual return for the Russell 3000 in that same year. So in general, the average max drawdown in a given year over the last 20 years has been almost 15%. And then if you look across the chart there, only 3 years were negative returning years for the Russell 3000. So the real reason to show this is there are drawbacks. They're likely healthy for the market as it takes some of the froth out. It effectively takes some of that oversold condition out of the market and allows for the good fundamental companies to be evaluated and to be bid up, while potentially some of the stocks that benefited from the rising tide previously are pulled back out a little bit, because not every stock that runs is a good company. And so what we want to make sure we're doing is taking advantage of these drawdowns, again, to on the margins, either reallocate portfolios or allocate into new positions that have the opportunity to take advantage of this. I think, Bob, if you want to talk a little bit about kind of the overall firm view on how we do that, probably be a great opportunity.
What we're saying here is that for longer term investors, the thing to do is to stay invested. The blue lines represent positive years. Past 20 years, we've had 17 positive, 3 negative years. And the worst negative year was down 19%. Average rate of return was very good. So very additive to portfolio results. And we can look back even further, and we have. So typically about 1 out of every 4 years, 4 to 5 years historically for the S&P 500 is a negative year. The rest are positive or flat. And that has generated 9% or so over the years in the S&P 500 if you go back over the last 50 years or so. So what we do at Hapanowicz, we want to be opportunistic. I say that very carefully because opportunistic to us is identifying when prices are cheaper than they were in recent history. And we want to use that pullback, that drawdown to our clients' advantage in their portfolio. So our objective is to buy low, sell high. So when we get a pullback, we want to look and evaluate, should we be buying that dip? Should we be adding to positions or perhaps put a new position in client accounts? And when the market rallies significantly, we'll trim back. So we have target weightings for each asset in our clients' portfolios, and should a position deviate further than its range, one way or the other, we're either adding or trimming that position for you and reallocating to something that hasn't gone up yet. So the first question I'd like to talk about is number 3 on the list. That seems to be the one that's gaining the most asks today. Andrew, all right. So how do elections affect the economy? How do elections typically affect interest rates, if at all? Can you talk about that relative to how that affects client portfolios, please?
Yeah, absolutely. I think you hit the nail on the head with the 2 big questions there. It's interest rates and the economy. And with interest rates, a lot of people have said and talked about whether the Fed will be reluctant to raise or lower rates in a presidential election year. That's been a kind of a common talking point. But the reality is, if you go back since 2000, the Fed has either raised or cut rates in every single presidential election year, with the exception of one, and that was 2012. So the Fed, and Powell tends to follow along with his predecessors, is not reluctant to move or change interest rates during a presidential election year. That's kind of something that people expect, but hasn't really been proven out by history. On terms of the economy, we here at Hapanowicz don't really see that the politicians that are in office are going to necessarily move markets that dramatically. Yes, on the margins. And absolutely, there may be opportunities, as Bob just described, to take advantage of those opportunities. But the reality is, we believe that company stock prices are driven by that company's earnings. And so what we see is a very attractive earnings environment right now. We're going through earnings season for the first quarter right now. Thus far, it's been relatively strong. The first quarter of this year, where we saw 4Q 2023 earnings, was incredibly strong. A lot of beats and raises for expectations on earnings. So that is a very positive environment. One of the ways we see, and one of the reasons that we are positive on the market going forward. So we're not going to try tactically to plan portfolios around this election or this data that's coming out that shows X politician is winning in this state versus this state, because that's a really difficult game to play, and one that we don't think that you can really win that well. We're going to invest for the long term and based on a strategic view of corporate earnings going forward.
The markets react in the short term, can make an emotional reaction to the results of an election. But in the intermediate to long term, stock prices are driven by earnings, primarily by earnings. And if corporate earnings are getting better, the stock price is going to go up. It's really that clear cut. If earnings are going down or neutral, then that stock price probably is going to go down. Let's talk about Bitcoin. We don't have Bitcoin per se in portfolios today. It's been an extremely volatile asset class. Last year was great rates of returns for Bitcoin. The previous year was highly negative. What do we make of this Bitcoin and cryptocurrency phenomena, and how are they positioned in portfolios, if at all?
Yeah, it's a great question. There's been a lot of stories recently as the new Bitcoin ETFs have come to the market. This is I would consider it a nascent industry with, especially with the ETFs. And one in which it's difficult to assign a fundamental value to the underlying security that this ETF is built upon. So at Hapanowicz, we have not included either Bitcoin, any other cryptocurrencies, or the ETFs in portfolios, largely for that reason.
But we have participated in the infrastructure build out. So companies that we own through our investments have provided the computer chips, et cetera, the hardware that built all these crypto mining fields around the country and around the world. So we've participated, not directly, but through the infrastructure play.
I think what we would describe it as is buying the picks and shovels of the Bitcoin industry.
Right. So question came in, as you mentioned earlier, we've had a 5% pullback in the market so far. That's doesn't quite meet the definition of a correction, but nonetheless, it's pretty healthy pullback in the S&P 500. Are we going to be in a correction? And what do we do if we are in a correction?
Yeah, it's a great question. I think that, as we discussed earlier, these types of pullbacks or drawdowns are extremely normal and, as I mentioned, kind of healthy for the market to get rid of some of that froth that can develop in a really overbought situation, which is what a lot of technicians thought the market was in over the last couple of months. So are we in a correction? Are we in the midst of a pullback? Maybe, potentially. I'm not going to stake my career to whether we are or not. And I think that's one of the big reasons, because we're not trying to time the market, that we are able to succeed over the long term. Because yes, there may be opportunities as the market pulls back to add a little bit on the margin, to buy the dip effectively. There may be opportunities when the market runs to trim on that strength. But what we're going to do is we're going to invest in a prudent manner strategically across asset classes, and then generally overweight or underweight the places that we find most attractive.
I think the core thesis is that the capital markets are working, they're functioning just fine. Capitalism is alive and well. Capitalism looks a little different today than it did, 10, 15, 20 years ago, and it will probably look a little different going forward, and that's the natural evolution of anything. But again, capital markets are functioning just fine. There's a lot of startup companies. There are companies that are developing. We've all heard of NVIDIA and Microsoft, and we use their products and Google's products, et cetera, and those are highly, very fast growing companies. There are others, and there will be others, but by and large, the corporate earnings are what is going to drive stock prices, and that's going to drive the results in your portfolio. And I can tell you, as Andrew mentioned a few minutes ago, that the outlook for this year has gotten better than it was 3 months ago and better than it was 6 months ago. So corporate earnings, by and large, companies are adjusting their forecast and saying we expect better results than we thought 3 months ago. And that should translate eventually into higher returns in portfolios. There have been, we call them geopolitical, right? Another word for wars. Ukraine has been in conflict with Russia now for over a year. Israel is in conflict somewhat with its neighbors. That's been put on pause recently. How do those geopolitical events affect client portfolios? Is it something we should be concerned about?
Yeah, it's a great question. It's kind of a funny backstory here. I'd have to reach back a couple decades now, but when I was in college, my senior thesis was actually on macro events and how they impact and when they impact the markets. So I've been looking at this for a very, very long time. And there are a couple of things. The first is the scale of the geopolitical event, whether it's a war, whether it is a assassination, whatever it might be, that can make a difference. The other thing is whether it coincides with a recession. And I've used that term coincides very specifically, and I'll mention why in just a second. When we look back at history, and especially over the last probably 50 to 70 years, and we looked at the major geopolitical events over that time period, in general, markets reacted negatively, but only by about on average 1.1% the next day. So not an enormous reaction by the marketplace, but still a reaction nonetheless. The average drawdown for those events, and they span from a president being assassinated to attacks on U.S. Navy ships, anything in between, the 6-day war, other things in the Middle East.
Oil embargoes, yeah.
Oil embargoes, exactly. The average drawdown for those is about 4.7%. And it only takes us about 42 days to get back after that drawdown to normal. So the reality is that these geopolitical events don't really hamstring the economy that much. Now, the reason I used the term coincide previously was, and I'm glad you brought up the oil embargo, because some of these geopolitical events happen at the same time with other recessions. So the 73 oil embargo is a great example, something that probably led to contributed to a recession that was happening at that time. On the other side of the coin, though, we have something like the bombing of the USS Cole, and the Yemeni bombing, as some people refer to it. That happened in 2000. And all of us can remember what was going on in 2000. There was the dot-com crash. Now, did the bombing of the USS Cole lead to the dot-com crash? No. And this goes back to our thesis that corporate earnings is really what ultimately leads to stock prices. What happened during the dot-com crash was people started to realize that a lot of these companies, and many of them were advertising during the Super Bowl that year, coincidentally, didn't have the earnings, didn't have the profitability to sustain themselves going forward. So those companies sold off. Did that geopolitical event lead to that? Probably not. I can't say absolutely not, but probably not. So these geopolitical events can have a short-term impact, but we're not, again, going to change our portfolios based on any of these geopolitical events that are happening right now.
In the short term, emotional reactions can take place. So you get a drawdown, you get a pullback, 3, 4, 5%. And the intermediate to long-term stocks find their correct value. They find their correct value based on earnings results and dividend payments from companies. Should those be positive? Should they be gradually increasing? Stock prices are going to go up. And that's what we've seen, and that's what we expect to have happen. So, all right, we're going to wrap up. Andrew, thank you very much today for joining us from Fort Mill. And it was an excellent presentation. Thank you for that. We invite everybody, should you have any other questions, just email me. Everybody has my email address or their advisor's email address, whether it's Bernie or Chris or Bobby or Roman or whoever. please feel free to email us. We'll be sure to get back to you and answer your questions. If this spurs any further thought about your portfolio positioning in your portfolio, I'd love to hear from you. With that, thank you. Thank you again, Andrew. I'm Bob Hapanowicz, and have a great day, everybody.